Hey everyone, welcome to the KE Report and a daily editorial as we are chatting with Jim Tassoni, CEO of Armor Wealth Strategies. Jim comes on the show to share his insights into more being an active investor and trader in these markets, really with a shorter term time frame, about 1 to 3 months. Jim, one thing I am hearing from a lot of our generalist guests are the amount of opportunities in the markets, the widening of breadth outside of just those Mag 7 names and the biggest tech names into some of these sectors that were lagging for the last couple of years. And some of the charts I've seen of how much some of these smaller stocks have moved is quite impressive. So, from a active trading standpoint, especially with the short-term outlook, are you seeing a lot of opportunities as well, Jim?
Yeah, well, thanks for having me on again, Corey. And I would say that yes, there is definitely opportunities out there, as there always are, but I would caveat that with the fact that there are also potential landmines that we have to work around as we look to invest in this environment. And one of the biggest ones we still see is sort of navigating these policies of the Trump administration and whether or not they will continue to fuel growth and or stoke inflation. And right now, we're kind of seeing that they'll do both. So we're sort of in what we would call a reflationary regime, meaning that we don't necessarily see growth falling off a cliff in the next 1 to 3 months, which is kind of the time frame that we feel comfortable forecasting out. But we also don't see inflation meaningfully coming in. We actually see it potentially continuing to move higher, which would hurt interest rate sensitive groups, including things like you talked about, like the small caps, where they are much more dependent on financing, and higher interest rates make it much more difficult for those companies because they tend to be a lot more debt burdened. So we're looking for areas that can benefit from higher inflation, higher rates. Again, we do think there's opportunities, but we are somewhat nervous about how things play out here over the next 3 months. We stay bullish right now, but we think there could be some hiccups and some volatility as we head into the spring and summer.
Well, Jim, you had mentioned to us off mic that you were looking at the financial sector because that is a sector that will benefit from higher rates. So maybe give us your thoughts there.
Yeah, so we that's actually our favorite sector currently is the financial sector in the US equity markets anyway. And the reason that we like that sector is exactly what you said. One, we feel the sector can benefit from higher interest rates that we think are going to be higher for a sustainably longer period of time. And two, we also think that many of the policies being introduced by the Trump administration with regards to deregulation, loosening some of the constraints, allowing banks to have more opportunities out there will ultimately benefit their business models. Obviously, a highly regulated industry like the banks, like the financials, can only benefit from less regulation.
Jim, what is your outlook then, even longer term for rates? We keep on hearing about how the glory days of 0% rates are behind us, but quite frankly, it doesn't seem like we have the Fed pivoting and starting to hike rates anytime soon. So is this just more of simply the stable rate environment, maybe a range bound long and short term rates?
Yeah, I think you may be onto something there, Corey, because what I see is a huge push and pull right now in the market. Now we've got a new Treasury Secretary coming in, and Scott Bessent he's come out and he has said unequivocally that he wants to keep the 10-year low. That's one thing that he is looking to do. He does not want to see our 10-year rate, interest rates in general, especially on the longer end of the curve, run away. And he is going to do things and enact policies that will help keep that lower. Now, with that being said, some of the other policies that are being put forth are definitely inflationary and could stoke interest rates to move higher. So there's a battle right there, and that could lead to some of this inside range type movement that we've seen. Now, right now, I think that we're still in a position where my call has been, I still think we have the opportunity to see 5.5 on the 10 year, which I know is a bold call right now, seeing as we're sitting around 450, 455 on the 10 year. I think we see 5.5 before we see 3.5. At 5.5, I would be very comfortable adding to my duration in the fixed income markets. But right now, I think we're range bound. I think investors are much better off if they want to have an allocation to fixed income, staying on the short end of the duration. We're staying in that 1 to 3 year area. You can pick up the majority of the yield staying right in there and have a lot less duration risk.
Well, Jim, it's really a wild environment because this was a year coming into it where a lot of people thought we would see more Fed rate cuts than we're actually going to get. Jerome Powell addressing his Humphrey Hawkins address just this week, and it doesn't look like they're going to change course at all. They're kind of in a neutral territory. If bond rates go up on the long end of a curve even higher, that means there's lower bond demand. So how are you looking at the bond market?
Yeah, so we're staying away from the long end right now. We think maybe back half of the year, there could be an opportunity to move out on the duration spectrum and get a little bit longer in our duration, look at 10 years, 30 years. Right now, we're staying in that short end. We like the 1 to 3 year area. You're getting, like I said, basically all of the yield in the market right now. So there's really no reason to be out longer, in our opinion, on the duration curve right now. Let interest rates creep up a little bit if they're going to, which we believe they will. Let bonds sell off a little bit from here, and then I think you may have your opportunity in the back half of the year to add to that duration and look at longer end bonds.
All right, Jim, one other sector. You said that you are long in, and that is gold. We talk a lot about the precious metals on this show. I also asked you, what about the miners? You had a different take on that. So can you share kind of your insights on your gold trade balanced with the potential of entering the equities?
Yeah, and we talked offline, and I said, admittingly, we probably got this trade wrong. We have been very long of gold for a few months now, and that's been a great trade, but we avoided the miners. We felt more comfortable in the actual gold market, and that's been wrong. We made money, but GDX has obviously outperformed GLD or the gold futures during that time frame. With that being said, we continue to just be more comfortable in the actual metal than the miners for a couple reasons. One, with the miners, while we think right now with where we stand, they're still positioned for more upside. We're worried overall about the global economic vitality moving into the back half of the year. And we think an economic slowdown across the board will hurt all companies and the miners along with that. So we like to take that, I guess I would call it business risk, off the table right now, given sort of our outlook for the overall economy. We also like the metal because there's some things going on within the metal that maybe aren't necessarily as beneficial to the miners. They may be as a derivative, but things like central bank buying, things like we talked about, where we now have the Treasury talking about pegging their gold holdings to market to today's price of 2,900 versus that $42 price where they were pegged before this. We think that may put a floor in for gold if they do something like that. And that floor would be wonderful because then we think there would just be an opportunity for continued upside. We think there's a lot of international players like China, for instance. They're running their economy at a huge surplus. They need to find a place for their currency. And we've seen them start to shy away from treasuries. They once put a lot of that surplus into treasuries. We've seen them start to move away from that and start to shift that investment more into gold. And if they continue to do that, we see that as maybe one of the catalysts, along with several others, to take gold another leg higher.
Yeah, Jim, China's been selling treasuries for years and buying gold for years, so they've really inverted that buying pattern in a backdrop of tariffs. The U.S. has tariffs against China, and there's tariff threats out there. Some of them are seen as a bargaining chip for Trump and pushing his weight around to try to get other deals done. But you brought up a great point off Mike that there's also the potential that some of these tariffs actually hit, and what could that mean for industry? I'd love you to weigh in on the tariffs.
Yeah, and that's one of our biggest, I guess I would call it left tail risks right now in the market that we're keeping a close eye on because most of the investors and other professionals that I talk to are still under the assumption that the talks of tariffs by the Trump administration are really seen as more of a bargaining trip. I don't think the markets or investors in general are really thinking at this point that they're going to go into effect, at least at the levels that President Trump has spoke about. So we think the market is not pricing that in right now. And if those tariffs actually get enacted, and if they go into effect, we think there's a lot of downside to the equity markets in that scenario.
Jim, is that just a quick washout for these markets then? Would that be a buy the dip opportunity, or is there something bigger, a change truly in momentum then?
So I think that remains to be seen. We have to see. I hesitate to say that with the markets we've seen over the past decade, really, that any sell off is anything more than a buying opportunity because they all have been. But with that being said, if we have a shift in the overall geopolitical climate, we could see a global growth slowdown that could linger longer than any of us are really anticipating at this time. And I want to preface that by saying I'm not a doomsdayer. I'm not saying that we're in for a market crash or a protracted bear market that's going to last years. But I do think the potential for a left tail risk here as we head into the summer is maybe higher than usual. And it at least makes sense to pay attention and be on the lookout, have your levels, have your areas, and also have yourself positioned into markets and sectors that hopefully can weather the storm better than others and can come out better on the other side.
Well, Jim, with all of the focus on the tariffs, if some of them do get enacted, most people believe that they would be inflationary. And if we see inflation start ticking up, and it has ticked up a little bit over the last few quarters, if it does tick up a little bit and not just keep going down as everybody assumes, would that change the Fed's playbook to not cut rates, but consider hiking rates?
Oh, that's a great question. And right now, obviously, I don't see a hike on the horizon. With that being said, I also don't think that anything is off the table. I think if we truly had a turn of events to that magnitude where inflation started to not just creep higher, but move substantially higher at an accelerating pace, I would think that the Fed would at the very least have to start hinting at it or have to start looking at it. And I think that could be even more downside pressure to the overall equity markets. And again, a reason why I think it makes sense to hedge your portfolio with assets that typically do well in inflationary environments. And that's how we're positioned across the board right now.
So then, Jim, any other sectors that you're looking at that you see as being that near-term trading opportunity?
Yeah, so the last one, and I mentioned offline, we're kind of doubled down on this sector is we like the energy sector and oil in particular. We're heavily invested in the XLE ETF on the equity side. We also have a position in our ETF portfolio in the USO. We think that oil can potentially move substantially higher as some of this inflation and maybe depending on how the tariff negotiations and tariff talks go, we think there could be potential upside for oil in those situations as well.
Okay. Jim Tassoni, CEO of Armor Wealth Strategies. Jim, it's always fascinating to hear what you are trading, and we'll get another update with you either later on this month or early next month. So again, thanks for joining us. And if you want to learn more about Jim's trades, follow along with him at the Armor Wealth Strategies website, which we will post to in the show notes. Thanks for your time today, Jim.
Thanks, Corey.